Hey guys, welcome to episode 6 of my Robinhood Portfolio, and today I want to talk about what the portfolio has been going through. I try to do these every week or so, maybe every 2 weeks, but we're going to dive right into the portfolio. The portfolio has eclipsed the 10K mark, and it's pretty much a ground stone for me whenever I see $10,000 because I feel like 10,000 when you reach $10,000, it kind of feels like that's when your money has a little bit of weight to throw around. It's definitely a landmark for myself to build more wealth and to maybe try to get this portfolio to $20,000 by the end of the year. But we're going to talk about what I've been doing. If I have I sold anything? Have I captured any dividends? What are my outlooks for this volatile market? The market has still been there's been a lot of volatility in the market. Again, the market has been up and down these last few weeks, maybe since February. Since February, the market has been up, it's been down, it's been a lot of volatility as far as me losing I've lost $300 in one day, I've lost $90 in one day, I've lost $70 in one day. But if you have a long-term outlook and if you know what you're doing, if you make some smart plays, I'm not saying that every play that I make is smart, but I try to do my D&D, and I really try to get ahead, try to get ahead of the game by investing in these dividend stocks. And I look at earnings and I look at reports. I just the other day, Amazon, they crushed their earnings, and the stock, I saw the stock, I was just looking at it on my phone. I was just in absolute shock that stock just shot up. I was sitting there and I'm like, wow, how come I didn't place any options calls? How come I don't do options? Well, that's a good topic to talk about, actually. Why don't I do options for my Robinhood account? Well, the reason why I don't do options is it's not the reason why I don't like options. It's more of the fact that I don't believe in it, because I've always been an investor who's I've had to learn the hard way in the stock market. I've always been a believer of not timing the market, and I always feel like when you time the market, you're going to lose 70% of the time. It's not a trend that is learned very likely. You really have to have the analysis and the analytics to sit behind a computer or your phone or what have you, and try to time what these stocks are going to do. And I've just learned that it's just a recipe for failure. It's a recipe for failure, guys. The way to do it is you buy a stock and you hold on to it until it reaches a buying. Until your stock reaches the selling point, and then that's when you want to sell off that stock. You want to try to sell high, but I'm not a fan of timing the market, and that's pretty much what options trading. That's all what options trading is. Especially when you put in calls. When you put in calls, you're timing. Well, you're pretty much predicting what a stock is going to do. Is a stock going to go up? Is it going to go down? Are you going to place puts on a stock like Amazon that they crushed their earnings, and the stock just jumped all the way up to about $1,600. I think it went past $1,600. It was just crazy. But let's talk about my portfolio. What have I been doing with this portfolio? And you could probably look at what I've been doing. There's really not a lot of positions. I had more stocks than this. What's been going on? What have I been doing? Actually, you just look down there. You just see like 100 shares of this SPHD. What's going on? Why did I do that? Yes, let's go on ahead. Let's talk about the portfolio. $10,049. We're talking about a stock like Apple. Really needs no explanation. I actually had 5 stocks in Apple. They took a little bit of a hit today. My average cost was about $168. I think I tried to sell this high. I made a little bit of money while it was on its way down, but I bought it back in, and I really don't to just try to, just buy stocks and get out and get in. I try to do some fairly good swings, but I bought back in at about 163, and right now it's at 162. So yeah, again, stocks, when you buy back into a stock, it can keep going down, and that's how it works, guys. You buy into a stock, you make a good swing trade, you make some money, and then you jump back into a stock, and while the stock is still going down, and you still lose money. So right now, 3 shares, average cost 163. I think that's I think that's a pretty decent average cost. This thing got all the way down to about I think it was 160, which is really just ridiculous. I think that $160 for Apple, that is a really, really good buying point right there. And you just look at the stats for Apple. It's almost $1 trillion company, guys, and you look at the PE ratio, 16% of a PE ratio for $1 trillion market cap. That tells me that this stock is really, really undervalued. It does. It just screams to me that it's undervalued. They pay a dividend. This is a blue chip stock. It's one of my it's one of the stocks that I have to keep in my portfolio. And it's my only tech stock. So what I've been doing with my portfolio is it's just really trying to allocate my money to each market sector. I looked at my diversification. I said, okay, I want to be in all the sectors, but I want to be in good sectors. There's been a lot of consumer staples getting hit really hard, and I want to see how low that's going to go before I jump back into these consumer staples. I've been doing some swing trades with Nike. I think I looked at Pepsi, they're going down. I looked at Procter and Gamble, they're going down. So a lot of these consumer staples they're getting hit hard. The next stock I want to talk about is McDonald's. I think I have a good average cost with them. They have a very, very good support level at $155. It's a great stock. I like McDonald's because they pay a great dividend, a great consumer services stock. Or you can look at this as a discretionary stock. The PE ratio is right where it needs to be. The dividend yield is just phenomenal. They have an earnings report coming up, which I think they should beat. They should beat this earnings report. I like McDonald's. It's a blue chip stock. I think it's really well for a growth portfolio that's trying to capture dividends, so I'm not going to really too much say about them. The next stock I'm going to talk about is Costco, and I've jumped into Costco, I think around 192. I wanted to get into Costco around 191. But this is a new stock in my portfolio. It's really just holding the discretionary sector down from my portfolio. So it's really allocated. My portfolio is allocated by market sector. We saw Apple, which is tech. You saw McDonald's, which is consumer services. And now we're seeing a discretionary stock for Costco. And I'm actually up on them for $11. But why did I buy Costco? Well, I try to stick to stocks that I have personal experience in. If you look at what Costco is doing, they have all those warehouses filled with decent products, and I've been in a Costco warehouse, and the store is very clean. The warehouse is very clean. They do a great job of advertising their business. And another big thing, reason why I bought Costco is their food court. Their food court, guys, is absolutely phenomenal. You can do everything with that food court. You can feed a family of 4 by buying a pizza for $10, guys. For $10, they have some of the best hot dogs you will ever find on earth. Like their hot dog sells at $1.50. You get a drink with it. And it tastes so good. It's cheap. It's good. I think they sell churros. They sell everything in this food court, and they make a lot of money from their food court. More money than I think Walmart and Sam's Club. I know a lot of Sam's Clubs have closed down. But again, I just think that the pizza, you can feed a family of 4 for $10. That is reasonably just amazing. And when the market is crashing and everybody's losing money and all this other stuff and the recession, this is what's good. These are the stocks that people are going to turn to. I'm telling you guys. When you feed a family of four for $10 with a whole Costco pizza, that's the reason why I went with. I'm really giving some love to Costco here. It's a blue. I feel like this is a blue chip stock, even though the market cap is not as high as some of the other stocks that I've been going through. But again, guys, I'm going with what I know. I've been in Costco. I've been in the warehouse. I've been shopping at Costco. They have a great business. They have they're in a great market sector as far as I'm concerned. I know Amazon, there's a lot of fear behind it, but Costco knows how to make money, and I feel like this is a safe investment for now, even though they appear to be a little bit overvalued. There's a huge chance they can increase their dividend. There's more growth along the way. I like Costco a lot. The next stock that I want to talk about is my utility sector. I'm still holding on to Next Era Energy. I mean, what can I say about the stock? I mean, 153 average dollars for average cost. They're one of the best utility stocks on the Eastern market. They do a lot of work, a lot of projects on the East Coast, as far as Florida. I'm central, but I live in Central Time, but just they're one of the best East Coast utility stocks. They have all those windmills, and they do a lot of utilities works for on the East sector. But look at the stats here. PE ratio 946, dividend yield 252. So you look at the price of the stock, which is $163, and you look at the PE ratio, which is only 9.46. What does that tell you? What does that tell you? So investors are willing to pay $9 for every $1 of earnings for a $163 stock. Guys, this stock is undervalued. I would even say this stock is possibly undervalued. I mean, even looking at it, this stock that tells me that this stock probably should be a little bit higher than what it is, and it's going up. It's going up. I got in at $153. They pay a phenomenal dividend, which they are only increasing. This is probably, in my opinion, one of the best utility stocks on the market. So the next stock I want to talk about is Boeing. And again, Boeing has just been up. They've been down. They've crushed their earnings report. They absolutely crushed their earnings report. So every time you look up, you see Boeing, and they're doing deals. I look at my Seeking Alpha reports. There's a deal happening just about every day with these airplanes, these jetliners. This is the This is the best stock in my portfolio as far as total return, up 18% for $160. I wish I would have got in lower, but it's a great industrial stock, guys. This is Boeing is, you got to get in Boeing. I love Boeing as my industrial sector, that holding down that industrial sector. You look at the graph for the year, it is just absolutely great. Return of 91%, and for the 5-year chart, up 323%. That is just phenomenal. I love Boeing Airlines. I'm not selling those shares. So the next stock I want to talk about is Visa. And I've been doing some swing trades with Visa. I recently got into Visa after their earnings report. I tried to sell this high, but then I thought about it and I said, why am I selling Visa? Visa is a blue chip stock. They absolutely crush earnings. So I jumped back in, a little bit risky. I actually don't like jumping back into stocks after their earnings reports, because a lot of that, what happens is a lot of people take profits, but I think that this is the right call here. This is another consumer services. I would say this is a consumer services stock. Right now, consumer staples is not looking really to all that attractive to me, so I'm just going to wait on this consumer staples sector to just keep going down, and I'm just going to let it keep going down. I'm going to try to buy into that sector, something like a Nike or a Pepsi or a Procter and Gamble. Some of my favorite staple stock. I'm going to try to buy it as low as possible. But Visa is a great blue chip stock that's not going anywhere. The next stock I want to talk about is Pfizer. Really up on them, $37 with an average cost of $34. I've been thinking about locking in profits with Pfizer, but they have an earnings report coming up, which I think they should. I think they'll fairly beat it. I'm not really. I'm really confident saying that they will, but if they don't, then I'll just average down. I feel like they have a great dividend yield. Again, the PE ratio is another thing that I look at when trying to justify whether or not I should add more shares. Look at the market cap. Look at the volume. 10% PE ratio. It's really good for a healthcare sector stock that will pay you a dividend yield of about 33 cents. And I have 20 shares, so we're looking probably about around, I don't know, about $6, $7, or $8 dividend increase for this portfolio. All my stocks pay a dividend and that's what compounding is all about, compounding that interest. Next stock I want to talk about is my financial sector, Bank of America. They've been just kind of all over the place. I actually reduced a lot of my positions by taking some profits off the table as far as my stocks. You look at Apple, McDonald's, Costco, all these stocks have 3 shares in them, and now Pfizer and Bank of America, they have 30 shares. I sold off 10 shares, and just trying to balance things off a little bit. But Bank of America is a solid bank. I like the PE ratio. I like the dividend yield. There's an opportunity that Bank of America, I feel like there's an opportunity that they will increase their dividend yield. Solid market cap. It's one of my favorite. I would say favorite. I would say it's one of my favorite banks. I do bank with them. I know a lot of people don't like Bank of America, but again, it's not about what you don't like. It's just about how can this stock make me money, and it's been making me, I would say, pretty good money. $10 for a 1% return. That's really not bad, and I just hope that this stock keeps going up. So now we've gotten to the part where I really wanted to focus my portfolio. I went over the stocks that I have individual shares with. You take a look at Apple, McDonald's, Costco, and all the way down to Bank of America, which holds about 8. It's 8 stocks, 8 individual stocks, and now we're getting to the ETF part of my stock. So we're going to go on ahead and look at SCHD, the Schwab U.S. Dividend Equity ETF. So why is this? What is this ETF? Like, what's inside this ETF? Why did I buy this ETF? So we look at some of the top holdings in this ETF. We have like Energy, Verizon, Pfizer, Home Depot. I actually have some Pfizer individual shares in Pfizer. But we look at this ETF. Why did I buy it? Well, really, I really bought this because it's really heavy on industrials and technology. And if you look at my other stock, SPHD, is really heavy on RITs, and I think I think it's heavy on RITs and stuff like. I'm actually on my computer, and I'm just looking at the top holdings for this, but utilities and RITs are the focus for SPHD, and SCHD focuses on industrials and technology. So what am I trying to do? Like, why did I buy this? Well, it's pretty much not overlapping with the SPHD, which I have 100 shares of. So now this is SPHD has become the largest position in my portfolio by far. But I want to talk about SCHD. I just got in some today. It's a portfolio diversification of 12%. For $48.92. We're just going to look at some stats here as far as what's been going on with the stock. This stock is on sale, guys. It's on sale about 8%. That is a good time. I felt that was a good time to jump in. I think the PE ratio is reasonable enough at 16%. Dividend yield at 3%. Great dividends. I like this ETF. I like this ETF because it really helps the SPHD out a lot. It focuses on what the SPHD doesn't focus on. It. There's no overlapping with these two ETFs. And again, I feel like the expenses for this ETF, I think the expense ratio is around, I think I'm going to say 0.07. I'm going to check. Just going to confirm that on my computer. And yeah, the expenses for this ETF, 0.07, which is very, very good. I look at, when you look at most ETFs carry a expense ratio of about, maybe I would say 0.40 or higher. So this ETF is considerably cheap as far as portfolio management. And when we talk about ETFs, we talk about so there's like a portfolio manager that manages the ETF for you. It's filled with certain stocks that have a great diversification of holdings, and that's the whole point of you buying an ETF. You'll never see like the price of the money taken out of an ETF. You'll never see it. Like I'm looking at all this right now, I just see market buys. I don't see any money taken out, but the expense ratio for the stock, I believe it comes out at the end of the year, or you look at the expense ratio for, in this case, SCHD, which is 0.07, which is very, very reasonable. This is a very reasonable, cheap ETF for what it does. So that's the reason why I like this ETF as far as SCHD. And that leads me to the SPHD stock, my largest holding by far, which actually had a good day. But we're going to talk about the why did I do this? Why did I buy 100 shares of this? Well, the reason why is that there are in the world, there are three types of income. There is earned income, there's portfolio income, and there's passive income. Now, for me, I'm going to talk about, like, I'm 32 years old. I go to work, I get money. I'm happily employed. I go to work, I get earned income. Earned income is money that's active income. I'm earning the income by trading. I would say hours for dollars. I would say I'm trading my time to make money. So I'm going to work, I'm investing my time to make money, and that's pretty much what I'm doing. I'm going to work, I get paid, I get a check, no job, no check. I don't have a trust fund. I would like to think I have a trust fund that I'm trying to create, but that's the three types of income: earned income, portfolio income, and passive income. So I want to talk about portfolio income. Portfolio income is the money that I'm getting in this portfolio, the money that I've gained by my capital interest, as far as what are my total returns are. So, for instance, if I were to sell all these 100 shares of SPHD, that would be my portfolio income of about $75. And if I were to sell out my whole portfolio right now, I think I would have about an extra $500 of portfolio income generated by selling off all my shares, which I don't want to do because I'm in it for the long term. But that's my portfolio income. My portfolio income is basically me trying to compound interest, trying to compound my return by adding shares. So the next thing I want to talk about, and this is probably the most important aspect in this video, is passive income. I don't have any passive income, guys. I don't. The only passive income that I get is from dividend stocks, and from dividend stocks, which is the reason why I try to make my entire portfolio pay a dividend. And this is the reason why I took Amazon stuff like Amazon and Google and all that stuff out of my portfolio, because I'm focusing on compounding interest. And if you look at Amazon, which I'm just going to look at Amazon right now. I'm going to type it in Amazon.com. They don't pay a dividend. I know they have a huge PE ratio, but you look at the stock, they don't pay a dividend. They don't pay a dividend, and this doesn't mean that I don't like Amazon. I mean, I love Amazon. I've been in and out of Amazon, and just to show the proof that I have been in and out of Amazon, look, I mean, I market sell, market buy, I try to do limit buys, but sometimes throughout the day, thanks to my job, I don't have time to like set the option of doing limit buys. Try to do limit buys, guys. Don't go for market buys. I know it's kind of weird how I'm not following my own advice, but limit buys is what you want to do because you're actually buying at the price that you want. You don't want to buy the stock for a market buy because you could be buying at any price thanks to the market fluctuations. So again, Amazon, $1,570. They kind of took a lot of profit taking with this stock today, but they don't pay any dividends, guys. And that's the reason why, for me at least, as a 32-year-old male, I need to try to compound passive income. So how do I do that? Well, that's the reason why I put 100 shares into this SPHD, low volatility, high dividend yielding ETF. Now, the reason why I have 100 shares is because this ETF pays monthly. It pays a passive income of about $12 to $14 monthly. So I can make $14 extra monthly of passive income by holding on to these shares. Now, the thing by doing this is that, yes, there's pros and cons to buying 100 shares of SPHD. There's pros and cons to buying like 25 shares of SCHD. I look at the SPHD. It's heavy on utilities and real estate. So those are markets that have really been struggling throughout this correction, if you want to call it that. You look at utilities like, I don't know, something like a GE, or you look at real estate like Reality Income or something like that, or real estate like APLE, the ticker symbol APLE, Apple Hospitality. Those kind of stocks have not been doing well, and that's probably the reason why this ETF has not been doing well. If you look at the graph, I'm just trying to pull it up here. The graph for this ETF, that's a big dip for a low volatility stock. The low volatility ETF that dipped about 8%. I remember I bought it somewhere right here, which ended up being a totally good buy. But I've been buying more shares and have just been averaging up a little bit to about, I think it's around $39.18. That's my average cost. But this ETF is nowhere means perfect. This is not a perfect ETF, and that is the reason why I bought SCHD, because these two ETFs, they work hand in hand in covering each other's weaknesses. SCHD focuses on a lot of what SPHD does not focus on, and the benefit of holding SPHD is I get a passive income. Now, for a 32-year-old male that has no passive income, I want to be making money effortlessly, guys. I want to be making money by just not knowing it. I want to be making money by compounding interest. I talked about this in my M1 Finance account. I want to be making money just by sitting on my butt and not doing anything. I think that's the best kind of income you can do. I want to be making money by doing things that I love. So I look at that as passive income, and the best way in my opinion, to receive passive income is by getting it through dividends. So I looked at SPHD. They have a great yield of about 4%, PE ratio of about 22%. This actually was 30%, but for some reason Robinhood fixed that. I guess it went down. But this ETF is really this ETF is actually interesting in a sense, because again, most ETFs have a expense ratio of about 0.40, 0.50, but this ETF has a extremely low, I wouldn't say extremely low, but they have a very interesting expense ratio of about 0.030%. So it's a little bit lower than usual than what you see with like these other ETFs floating around. I think the best ETFs on really are the Vanguard ETFs due to their low cost. I think I had a whole bunch of Vanguard ETFs when I first started my M1 Finance account. But guys, that's the three types of income that I'm trying to focus on. Three types of income. We have earned income, me going to work and being active. Portfolio income, my entire portfolio working for me, and my money working for me, and the money not working for it. So I'm working. My money, I go out. I say, okay, I'm putting money out there, and I want that money to come back to me and say, okay, I brought you even more money. That's what I'm trying to do. That's portfolio income, and I'm not going to sell my shares. I say, okay, yeah. How did my portfolio do today? Okay, up $50. That's portfolio income. I say I put money out there, and money brings back more money. That's my money works for me. I don't have to work for my money. That's portfolio income, and that's what I'm all about right now. And then the last one, the last three types of income is passive income. I had no passive income. I had other than the dividends that I was getting, which I looked at and I said, okay, yeah, I get a dividend from Apple. Okay, yeah, that's $2. I get a dividend from Costco. That's like $3. Dividends off my stocks. I get about a $10 worth of dividends. To me, $10 worth of dividends. Why not? I need to start stacking. I need to start saying to myself, oh, I know that as long as I hold on to SPHD, I can get like $14 every month, and then that $14 will compound off an Apple. That $14 will compound off a McDonald's. That $14 will combo off a Pfizer, a SCHD, and I might get $25 for that month. That is the great. I love it. That's great passive income. So that's gonna do it for my portfolio, and now you guys see what I'm trying to do. Excuse me. I looked at what the market's doing. The market's been volatile, and so I said I need to focus on a little bit of passive income. I need to focus on a little bit of portfolio income, and I go to work, so I'm right where I need to be as a 32-year-old male that's trying to live off dividends, that's trying to get the portfolio to $20,000, $30,000, $40,000, $50,000. Why not $100,000? And it's going to take a lot of work, but I feel like if I could just once I start compounding all of these dividends and these stocks just keep going up, and I hold on for the long term, then that's what's going to push me to the next plateau, the next level. For me to get to where I need to be. And 8 stocks, 2 ETFs, I think that's a great diversification. And I noticed the market was sort of down today, and I ended up doing very well. So I like where this portfolio is going. I like how I kind of took profits off the table, and I put profits in these monthly dividend ETFs and stuff. I know it's a risk. Everything, this whole portfolio is one giant risk. But you know what? This is not my only portfolio. I have an M1 Finance account going. I set that up to just compound interest, and I feel happy. I'm happy that this portfolio is growing, and my money's working for me, and I'm not working for it. I know that for years down the road, when I'm 40 years old or 50 years old, I can appreciate that passive income. I can take vacations off my dividends, which I know some people. I've heard of people doing that. I've heard of people taking vacations off their dividends. Somebody who may have bought Apple back in 1997 and bought like 50,000 shares of Apple back in 1997, and now are literally living off their dividends. They're literally taking vacations off dividends, and that's where I want to be. So, guys, comment about the portfolio, comment what you think, and I'll see you next time.